Question 11. How do leveraged and inverse Japan ETFs work, and what are the risks associated with trading them? Leveraged and inverse Japan ETFs offer amplified exposure to the Japanese stock market, but they come with significant risks that require careful consideration. Here's how they work and the potential dangers involved too. Leveraged Japan ETFs. Function: these ETFs aim to deliver magnified returns, bullish or bearish, on a particular index or benchmark by using financial instruments like futures contracts or swaps. They essentially borrow money to magnify daily movements of the underlying index. Example: a leveraged ETF targeting a 2x return on the Nikkei 225 would aim to deliver double the daily percentage change of the Nikkei 255. If the Nikkei 225 rises by 2%, the leveraged ETF would ideally gain around 4%. Inverse Japan ETFs. Function: these ETFs seek to deliver the opposite daily return of an underlying index. They use inverse swaps or futures contracts to achieve this. Example: an inverse ETF targeting the Nikkei 225 would aim to deliver a roughly 1% gain if the Nikkei 225 falls by 1%. Important risks. Volatility amplification. The biggest risk is the amplification of volatility. While these ETFs magnify gains, they also magnify losses. A small decline in the underlying index can translate into a significant loss for leveraged ETFs, and vice versa for inverse ETFs. Erosion over time. Due to compounding effects and fees, leveraged ETFs might not perfectly reflect the magnified returns of the underlying index over longer periods. This means they might underperform compared to what they are aiming to track. Liquidity risk. Leveraged and inverse ETFs might be less liquid than traditional ETFs, especially for less popular ones. This could make it difficult to enter or exit positions quickly at a desired price. Gearing risk. The use of leverage inherently increases risk. These ETFs are complex financial instruments and might not be suitable for all investors. Not for long-term holds. Leveraged and inverse Japan ETFs are generally not recommended for long-term buy-and-hold strategies. They are better suited for short-term, tactical allocations aiming to capitalize on specific market movements. Due to the volatility and potential for erosion over time, they can be risky for long-term investors. Question 12. How do factor-based Japan ETFs utilize investment factors such as value, momentum, and low volatility, and what are their potential benefits? Factor-based Japan ETFs offer a unique approach to investing in the Japanese market by focusing on specific investment factors, beyond just market capitalization. Here's a breakdown of how they utilize these factors and their potential benefits. Investment factors. Value. These ETFs target companies that appear to be undervalued compared to their assets, earnings, or cash flow. They aim to buy stocks with the potential for future price appreciation, as their intrinsic value gets recognized by the market. Momentum. These ETFs focus on companies with a history of strong recent price performance, aiming to capture stocks that might continue this upward trend. Low volatility. These ETFs prioritize companies with historically lower stock price fluctuations, aiming to provide a smoother ride and potentially reduce overall portfolio volatility. How factor-based Japan ETFs use these factors. Selection and weighting. The ETF provider establishes a specific methodology to identify and weight companies within the ETF based on the chosen factor, value, momentum, or low volatility. This might involve using quantitative models and financial metrics. Example: a value-based Japan ETF might select companies with a low price-to-earnings ratio, P/E ratio, or price-to-book ratio, P/B ratio, indicating they might be undervalued compared to their earnings or assets. The ETF would then weight these companies within the ETF based on their value score. Potential benefits of factor-based Japan ETFs. Enhanced diversification. By focusing on specific factors beyond just market cap, these ETFs can offer diversification within the Japanese market. They might capture companies with strong fundamentals, value, or good recent performance, momentum, that traditional market cap-weighted ETFs might miss. Targeted exposure. Depending on the chosen factor, these ETFs allow investors to target specific areas of the market they believe will outperform. Value investors might seek undervalued companies with future growth potential, while momentum investors might target companies on an upward trajectory. Potential for risk reduction. Low volatility ETFs, by design, prioritize companies with less volatile stock prices. This can potentially help reduce overall portfolio volatility compared to a market cap-weighted ETF. Here are some additional points to consider. Factor-based investing is a relatively complex strategy. The effectiveness of an ETF depends on the robustness of the methodology used to identify and weight companies based on the chosen factor. Past performance is not necessarily indicative of future results. Just because a company or factor has outperformed in the past doesn't guarantee it will continue to do so. Factor-based ETFs might come with slightly higher expense ratios than traditional market cap-weighted ETFs due to the more complex selection and weighting process. Question 13. Are there thematic Japan ETFs that target specific trends within the Japanese market? Yes, thematic Japan ETFs exist and offer a way to target specific trends or growth areas within the Japanese market. These ETFs focus on companies believed to benefit from these trends, potentially offering concentrated exposure compared to broad market ETFs. Here's a breakdown of thematic Japan ETFs and some things to consider. Thematic ETF examples. Robotics automation. These ETFs target companies involved in robotics development, manufacturing, and integration. They capitalize on the growing trend of automation in various industries. Fintech. These ETFs focus on Japanese companies at the forefront of financial technology, including mobile payments, online banking, and blockchain technology. Sustainability clean energy. These ETFs target companies developing or utilizing clean energy technologies, or those with strong environmental, social, and governance (ESG) practices. Healthcare innovation. These ETFs focus on Japanese companies involved in areas like pharmaceuticals, medical devices, and biotechnology, aiming to benefit from advancements in healthcare. Benefits of thematic Japan ETFs. Targeted growth potential. By focusing on specific trends, these ETFs offer exposure to companies positioned to benefit from those trends, potentially leading to higher growth compared to broad market ETFs. Innovation play. Thematic ETFs can provide access to innovative companies at the forefront of their respective fields within Japan. Alignment with values. Some thematic ETFs, like clean energy or ESG-focused ones, can align with your investment values alongside potentially generating returns. Risks to consider. Concentration risk. Thematic ETFs are inherently concentrated on a specific theme or sector. This can magnify gains within that theme, but also amplify losses if the trend weakens or the sector experiences a downturn. Dependence on underlying trend. The ETF's performance relies heavily on the continuation and strength of the targeted trend. If the trend fizzles out, the ETF's value might suffer. Limited diversification. Compared to broad market ETFs, thematic ETFs offer less diversification, potentially increasing overall portfolio risk. Are thematic Japan ETFs right for you? Thematic Japan ETFs can be a good addition to a diversified portfolio if you want targeted exposure to specific growth trends within the Japanese market. However, carefully consider your risk tolerance and investment goals. These ETFs are suitable for investors comfortable with potentially higher volatility in exchange for the chance of amplified returns. It's important to remember thematic ETFs are still a relatively new concept, and their long-term performance track record might be shorter. Question 14. What role do Japan ETFs play in a global equity portfolio, and how should investors allocate to them? Japan ETFs can serve a valuable role in a global equity portfolio by offering several key benefits. Diversification. Japan represents one of the world's largest economies with unique characteristics. Including a Japan ETF diversifies your portfolio beyond your home market, potentially reducing overall portfolio risk through exposure to a different set of companies and economic factors. Exposure to potential growth. While economic growth might be slower than some regions, Japan possesses a highly skilled workforce and a focus on innovation. Sectors like robotics and sustainability initiatives show promise, and ETFs can provide access to these growth opportunities. Currency play. Optional. If you believe the yen is likely to weaken against other currencies, a Japan ETF can benefit. A weaker yen makes Japanese assets more attractive to foreign investors, potentially driving up the ETF's price. Here's how to consider allocation to Japan ETFs in your global equity portfolio. Overall portfolio weight. Generally, Japan is recommended to be a 5 to 10% allocation within a globally diversified portfolio. This provides some exposure to the Japanese market while maintaining diversification. Risk tolerance. Investors with a higher risk tolerance can allocate a slightly higher percentage, up to 15%, to Japan ETFs, aiming for potentially higher growth, but also accepting potentially higher volatility. Conversely, risk-averse investors might choose a lower allocation, around 3%. Investment goals. If you have specific goals like income generation, consider dividend-focused Japan ETFs within your allocation. For targeted exposure to growth trends, thematic Japan ETFs might be a suitable option, but keep the allocation size smaller due to their concentrated nature. Current market conditions. Consider the current economic climate in Japan and globally. If the Japanese market appears undervalued or poised for growth, a slightly higher allocation to Japan ETFs might be reasonable. Question 15. How do Japan ETFs differ from investing directly in Japanese stocks, and what are the advantages and disadvantages of each approach? Here's a breakdown of the key differences between investing in Japan ETFs and directly in individual Japanese stocks. Japan ETFs. Advantages. Diversification. ETFs hold a basket of Japanese companies, offering instant diversification and reduced risk compared to picking a few individual stocks. Lower costs. Expense ratios of ETFs are generally lower than the commission fees associated with buying and selling multiple individual stocks. Convenience. Easier to buy and sell on exchanges like any stock. Transparency. Holdings of most ETFs are publicly available. Disadvantages. Limited control. You don't have direct control over the specific companies held within the ETF. Tracking error. The ETF's performance might not perfectly match the underlying index it tracks due to fees and other factors. Less potential for outperformance. ETFs generally aim to match the market performance, limiting the potential for exceeding the market return through individual stock selection. Direct stock picking. Advantages. Potential for outperformance. By carefully researching and selecting individual stocks, you have the potential to outperform the market if your stock picks outperform. Greater control. You have complete control over which companies you invest in and can tailor your portfolio to your specific investment thesis. Disadvantages. Higher risk. Picking individual stocks inherently carries more risk compared to the diversification offered by ETFs. Time commitment. Requires significant research and analysis of individual companies to make informed investment decisions. Higher costs. Frequent trading of individual stocks can incur higher commission fees compared to ETF transactions. Liquidity risk. Some smaller Japanese companies might have lower trading volume, making it difficult to enter or exit positions quickly. Choosing between them. For most investors, Japan ETFs offer a good balance of diversification, convenience, and lower costs. They're a good way to gain exposure to the Japanese market, without the time commitment and potentially higher risks of individual stock picking. Direct stock picking might be suitable for experienced investors, with a strong understanding of the Japanese market and a high risk tolerance. They should be comfortable with the time commitment required for thorough research and analysis. Question 16. How can professional investors utilize options on Japan ETFs for income generation or hedging strategies? Professional investors can utilize options on Japan ETFs for various income generation and hedging strategies. Here's a breakdown of some common approaches. Income generation strategies. Covered calls. Mechanic. The investor sells call options on a Japan ETF they already own, covered by the underlying shares. The call option grants the buyer the right, but not the obligation, to purchase the ETF at a specific price, the strike price, by a certain expiry date. In return for selling the call option, the investor receives a premium upfront. O benefit. Generates income from the premium even if the ETF price remains flat or goes up slightly. As long as the ETF price stays below the strike price by expiry, the investor keeps the shares and the premium. O risk. If the ETF price significantly rises above the strike price by expiry, the investor might be obligated to sell their shares at the lower strike price, missing out on potential further gains. Cash secured puts. O mechanic. The investor sells put options while holding cash equal to the strike price of the option contract. The put option grants the buyer the right to sell the ETF to the investor at a specific price, strike price, by a certain expiry date. The investor receives a premium upfront for selling the put option. O benefit. Generates income from the premium and potentially benefits if the ETF price falls. If the put option is exercised, assigned, the investor buys the ETF at the predetermined strike price, potentially lower than the current market price. O risk. If the ETF price significantly falls below the strike price by expiry, the investor is obligated to buy the ETF at a potentially inflated price compared to the market price. Hedging strategies. Protective puts. O mechanic. An investor holding a long position, owns shares, in a Japan ETF, can buy put options on the same ETF. The put option gives the investor the right to sell the ETF at a certain price, strike price, by expiry if the price falls. O benefit. Provides downside protection for the ETF holding. If the ETF price falls, the investor can exercise the put option and sell their shares at the predetermined strike price, limiting potential losses. O risk. The cost of the put option reduces the overall potential return on the ETF investment if the price goes up or stays flat. Collar strategy. O mechanic. This combines selling a covered call, income generation, with buying a protective put, hedging, on the same Japan ETF. O benefit. Provides some income generation from the call option premium while also limiting downside risk by setting a floor price through the put option. O risk. Limits potential upside gains if the ETF price rises significantly since the sold call caps the selling price. The combined cost of the put and the lowered call premium reduces overall returns compared to a naked long position in the ETF. Question 17. How might Japan's aging population and shrinking workforce affect the long-term performance of Japan ETFs? Japan's aging population and shrinking workforce present significant challenges that could potentially impact the long-term performance of Japan ETFs in several ways. Negative impacts. Slower economic growth. A shrinking workforce can lead to labor shortages and hinder productivity growth, potentially slowing down the overall economic growth of Japan. This could translate to lower corporate profits and dampen stock market performance, impacting Japan ETFs. Reduced innovation. An aging population might have a smaller pool of young talent entering the workforce. This could stifle innovation and hinder the development of new technologies and industries, potentially limiting the growth potential of Japanese companies and the ETF. Higher government debt. To support its aging population, the Japanese government might need to increase spending on social security and healthcare. This could lead to higher national debt levels, potentially straining the economy and impacting investor confidence, which can negatively affect stock prices. Deflationary pressures. A shrinking population can lead to a decrease in aggregate demand for goods and services. This could put downward pressure on prices, creating a deflationary environment. Deflation can hurt corporate profits and stock market performance. Potential positives are increased productivity. To offset a shrinking workforce, companies might invest in automation and other labor-saving technologies. This could lead to increased productivity gains, potentially boosting corporate profitability in the long run. Focus on innovation. To address the challenges of an aging population, Japan might prioritize innovation in areas like elder care, healthcare, and robotics. This focus could create new growth opportunities for companies in these sectors, potentially benefiting Japan ETFs. Government reforms. The Japanese government might implement reforms to address the demographic challenges. This could include policies to encourage immigration, raise the retirement age, or increase female participation in the workforce. These reforms, if successful, could mitigate the negative impacts of an aging population. Question 18. What are the key factors professionals should consider when analyzing the future outlook for Japan ETFs? Professionals analyzing the future outlook for Japan ETFs should consider a multitude of factors encompassing both the Japanese market itself and the broader global economic climate. Here's a breakdown of some key elements to consider. Japan-specific factors are economic growth. Analyze trends in Japan's GDP growth, labor market conditions, unemployment rate, labor participation, and productivity levels. A strong and growing economy signifies a positive environment for corporate profitability and stock market performance, potentially benefiting Japan ETFs. Monetary policy. Evaluate the Bank of Japan's BOJ monetary policy stance, including interest rates and quantitative easing programs. A dovish BOJ with loose monetary policy can prop up asset prices like stocks, potentially benefiting Japan ETFs. However, prolonged low interest rate environments can also dampen bank profitability. Corporate earnings. Assess the profitability of Japanese companies, looking at factors like revenue growth, profit margins, and return on equity, ROE. Strong and rising corporate earnings indicate healthy companies with the potential for future growth, which can translate to a positive outlook for Japan ETFs. Demographics. Consider the long-term impact of Japan's aging population and shrinking workforce on potential economic growth, innovation, and government debt levels. While challenging, these demographics could also spur innovation in sectors like elder care and automation, creating opportunities for some companies. Regulation. Monitor any regulatory changes or reforms impacting specific industries or sectors within the Japanese market. Regulatory shifts can create new opportunities or challenges for companies, potentially affecting the performance of Japan ETFs. Global economic factors are global growth. The health of the global economy can significantly impact the performance of Japan's export-oriented businesses. A strong global economy with high demand for Japanese goods can benefit Japanese companies and their stock prices. Interest rates. Global interest rate movements, particularly those by the U.S. Federal Reserve, can influence investor sentiment and currency exchange rates. Rising global interest rates might make Japanese stocks less attractive to foreign investors, potentially putting downward pressure on the Japanese stock market and impacting Japan ETFs. Currency fluctuations. The value of the yen, JPY, relative to other currencies can significantly impact the value of Japan ETFs, especially for unhedged ones. A weaker yen can make Japanese assets more attractive to foreign investors, boosting the value of Japan ETFs. Conversely, a strengthening yen can erode the value of these ETFs for foreign investors. Geopolitical risks. Global geopolitical tensions or trade wars can create uncertainty and market volatility, potentially impacting the performance of Japan ETFs, especially if they escalate. Alright everyone, that's all we have for you today on Japan ETFs. We covered a lot of ground, but remember, this is just the beginning. Before you invest, be sure to conduct your own research, consider your risk tolerance, and consult with a financial advisor if needed. If you enjoyed this video, don't forget to like and subscribe for more insightful ETF breakdowns and investment strategies. We'll be diving deeper into specific Japan ETF types and exploring other exciting markets in the future. Hit the notification bell so you don't miss out. Thanks for joining the conversation on Chat ETF, and happy investing.